Bonds are much cheaper than stocks, says Jeffrey Gunlack. Dude, I'm the man. This guy right here. What's got two thumbs and is the man? This guy, two thumbs and is the man. I am the man. Now, I absolutely could be wrong. I don't know. But I completely agree. So I just got this in an email today. This guy, Jeffrey Gunlack. We got to come. Let's see. The bond market is much cheaper than the stock market. Investors should abandon the traditional 60-40 and switch in favor of a 40-60. Your old buddy Josh in the t-shirt with the dogs. But Josh, you don't wear a tie, or Josh, you don't believe in the moon landing, or Josh, you voted for Trump, or what I don't know, what else? You don't think we'll be able to power our whole economy on solar? Bond allocations to be proved to be much more rewarding this year than last. Well, you would hope, because I mean that's wow, woo, jeez, come on. He can justly be cited for talking his book since he oversees one of the world's largest pools of actively managed bond funds. All right? I mean, that's in of itself, that's a silly bond allocation would be much more rewarding this than last. Well, last they were the worst ever. Yeah. 1 year ago, bonds were above par, he said, which is not a good starting point. Now bonds are backed. That were priced at 102 are going for 60 to 75. I'm not sure what kind of bonds he's dealing with. We don't want to be anything at 60 or 75. That's crazy. They can easily appreciate back to par even if the loss is due to defaults. So he must be talking about junk bonds. Like no government bond, unless it's a zero coupon, will be that low from par. I mean, if you were trading at 102, a 2% premium, now you're a 30% discount in 1 year. That's not a bond you want anything to do with. Government bonds aren't doing that, that's for sure. So high quality bonds aren't doing that. But I see what he's saying. This is before you're trading at 2% premium, all right? Now you're trading at 30%, 40 to 25% discount. Either way, they're still coming back to par, which is 100. Gunlock is a founder of Double Line Capital, leading provider of fixed income mutual funds, all right? Let's see here. Before we look at his prediction, let's look how his forecast from last year held up. U.S. equities overvalued but cheap relative to bonds, he said. S&P 500 was down 18.6, where bonds were down 13.7. All right. Well, that's not his forecast. That is a bad year for stocks, but the worst among the last 27 years for bonds. Huh? I don't think he forecasted that. Are you saying that this guy forecasted that bonds would have one of the worst years ever? No way, man. Maybe. Well, I guess because everyone's saying the rates are going to go up. I guess I wonder what he said the year before that, the year before that, and the year before that when rates didn't go up. But anyway, headline CPI will be 7%. All right, so apparently he got all his predictions pretty much right on. So good on him. The Fed funds rate could get to 1.5% in 2022. Oh, I see. Okay, that's weird. He said the Fed funds would get to 1.5, and he still said bonds would have one of their a bad year. I have to look at that. I don't know. Anyway, that's pretty spot on for this guy, especially when he said Fed funds rate will only go to 1.5. Reflections on a remarkable year. Last year was the third worst for stocks since 1976. That's nuts, man. So we got 2008, 2002, 1973, and 74. Yeah. So in my lifetime, 1970, 73, 74, 2008, 2022, and I think that's it. Yeah. So I'm 52. So 2008, 2002. No, because in 2008, 2002, 73, 74, off the top of my head, I can't remember exactly what 73, 74 were, within the top five. And then 2022. So I've been 5 decades, 1 year every decade. So 10% of the time the markets fall pretty dramatically, according in terms of year over year. Not necessarily that's just year over. It's a calendar year in of itself that is frankly irrelevant, but that's still interesting nonetheless. You don't don't bet the farm on that. The Treasury yield curve was normally sloped with a since the Fed's June meeting, the S&P is up 4% and market stabilized. Commodities were the best performer in 2020. Okay, the Fed will hike in February. Okay, this is talking about last year. All right, so he got it all right up. Why the Fed won't get to 5%? A weakening U.S. economy will stop the Fed from raising to 5%. I completely agree with that. Supplier delivery problems are over, and backlogs are at the best level in 30 years, but some of those reduced delays are due to lack of demand. That's not inflation. The consumer is getting much more stressed, 100%. Housing is the least affordable since 1990, and that's due to interest rate increases. Well, I mean, that's no interest rate increase. The price of houses. Jeez, man. The interest rate increases came after the price of houses going up. I think it's absurd to think there'll be a rash of defaults. People just sell their houses. Yeah, I completely agree. Tons of equity still. But housing is not going to rescue the economy in 2023. Recession, the consumer spending spiked in 2022 due to this pandemic. Consumers are desperate now. Their high credit card usage is a sign of stress. Consumer sentiment is at one of its lowest readings last 40 years, but Sniffy Joe won the 2022 midterms. The ISM PMI is back in contraction. The yield curve is screaming recession. Sustained inverted yield curves have always led to recessions in short order. Investment grade and high yield spreads widened going to 2022, but are still not at recessionary levels. But spreads at the lower end, junk bombs predict there'll be some defaults in the next few years. Yeah. Inflation ahead. The market economists expect inflation to decline to around 2%, and they'll go dead sideways. Yeah, I don't know if I agree with that, but if the Fed gets inflation at 2% by the end of the year, it'll go negative. I could not agree more. This guy's saying if the Fed gets inflation 2% by the end of the year, inflation will be in full panicked deflation. Money supply growth has historically been a leading indicator of inflation. Coincidence, nothing more. It crashed in 22 to its slowest growth in 50 years. That presages low inflation. No, that's not true. Again, the money supply is not what causes inflation. I don't get this. Exports prices spiked about a year ago, but are coming down similar to import prices. Both are falling rapidly. Sign of lower inflation because of economy that's contracting. There's no other way around that. Inflation's coming down. It'll be about 4% by May, he says. Car and home prices are depressed and will not drive inflation. Car and home prices are depressed? Home prices are depressed? I don't know about that. Commodity prices will not drive inflation and have been falling over the last 6 months. Yeah, so the recession is here, and we're seeing it going to start playing out. I would say that's a forward-leading projection in commodity prices. It's a leading indicator, not a lagging. In my opinion, say, look, the price of commodities, i.e., what we use for energy, if that goes up, that inherently means things are getting more expensive, inflationary. When that goes down, that means you would think things would be less expensive, deflationary, but not when we're in a recession and people have already spent all the money they got. And now we got higher interest rates on top of that. It's recessionary, man. Come on. Recession always makes the government bonds look good. Gold has moved sideways. Real yields have stopped going up. Until the Fed relents on inflation-killing policy, PEO ratios will be depressed. Are they depressed? He tremendously favors non-U.S. stocks, U.S. stocks, starting with Europe. Okay, I completely disagree, but whatever. A lot of opportunity in emerging markets. There's a massive tailwind in the works for emerging markets because of weakening dollar. Huh? A massive tailwind because of weakening dollar? That doesn't make any... What? I disagree with that 100%. A weakening dollar means our imports to them are cheaper for them. Means their exports to us are more expensive for us. That literally makes no sense. I don't get it. What? Okay. Tremendous potential. Yeah, but I do agree with this. There is potential gain for Treasury securities on the long end. I completely agree. Commercial mortgage-backed security. Okay, let's see. There's a comment on here. I said I don't get the. Let's see. Thanks for a continuous series of interviews. Not generally the case, but I am close to agreeing with his time. I'm just going to type in here that I don't understand. Weakening dollar is a tailwind for exports, export or emerging markets. I mean, markets, huh? Means cheaper U.S. exports to them and more expensive U.S. imports from them. I don't get it, man. That's a weird. I don't get that. So weakening. Just type that in there. Weakening U.S. dollar is a tailwind. Tailwind means it pushes you like a sailboat. It means cheaper U.S. exports to them, so they're going to be buying our stuff. More expensive U.S. imports from them. I might want to read it. More expensive. It's more expensive for us to import from them, let's say, and more expensive for the U.S. to import from them. Count me confused. All right. Anyway, there you go. Whatever, man. I mean, it's all good, but I just, but Josh, you're not a professional. You don't even have a master. Well, I do have a master's degree, but you don't have a PhD. I don't care. Anyway, I agree with that 100% though. 60-40, 40-60 is my opinion right now. Way to go, for sure. Especially if you're within the retirement red zone. All right. Don't forget to subscribe. Don't forget to subscribe to my main channel too. I'll put a link in the show notes so you can subscribe to that. I need 1,000 subs so I can get that sweet, sweet YouTube money. Just subscribe. Be cool with your old buddy Josh. Help me help you by helping me. We'll see you.